If you send it. Yep. Then I'll just post it and then we'll like shoot it up there. It's quite a drive.
All right, is it Ben Dot Tilbury or Tilbury at KW? Hey Ben. Ben Dot Tilbury at KW?
Ben Tilbury at KW? Yes, that works. That's one of my many email. From me? I know. Well, I don't post my face lately. I've just started posting food.
Oh, okay.
And maybe I do. It's only like problems to the real estate. Like the headaches I have. I know, right?
Get a date probably and like. Yeah. So then. We got our So you guys do.
All right, the natural silencing. Okay. Love that music in the background.
Now it's all out. I know. I don't know. It is dark.
What do you guys do?
Yeah.
We'll play here.
Oh, you do? Yeah. There's one here. And there's two here. Here.
Down here.
Yep.
Only two, only we have, yeah. And then three and Mary.
No, the oldest?
Oh, it's second one.
Second out of 4.
And he was an achiever, you know.
He's still an achiever.
He had the routine down, he put himself to bed, we're watching the show. I'm in bed.
Wow, 8 o'clock every night, bedtime.
I think he was going, were you going to read?
I would read books.
Yeah.
Put myself to sleep. Yeah. All right, Ben, you get that posted?
Yep. I mean, turn off this.
So yeah, my wife is Chase Kennedy. She's.
I don't know if it's an open link or I'll hold this thing.
Lawyer.
Yeah.
Yeah, so. But yeah.
And is it accessible on Facebook?
You want me to, let me try to open
Test it out, see if you can get in. That way we can have people log in. Up and going.
Today, so there.
I just get
Get it up here. So, want to move to office. And we could have looked at this.
So you guys back in Shell or where are you at?
No, we literally
Yeah, yeah.
just before Bronco side trying to come back.
Okay, congrats.
We run out of money
Oh,
because we haven't sold our house yet.
I know how that feels. We're in the-
Yeah, it's working.
Cool. Hey, we got more people in the room.
I just, oh, there's someone else going?
Welcome aboard.
So.
Live. Tom Cook is in here.
Oh, that's okay.
Oh, that's you.
Are we ready to go?
Oh, that's you. Okay, Ben is in the room.
I'm in it.
We got a Ben. Ben's here.
That's weird that it prompted that.
What happened? Yeah, that's cool.
All
right. Hey. Hello, hello. Hi, everyone. Thank you all for being here. My name is Schwaegerle. I'm a real estate broker associate here at KW Central Coast. Real Estate Investor. And Ben and I co-founded this Real Estate Investor Meetup about 5 years ago. And the purpose is to network with other people who are out there doing it, investing in real estate. And we believe that real estate is the best wealth building tool out there. And where else can you get all the tax benefits and
All right, yeah. So whose first time is it? Wow, see, that's awesome. So like we get a lot of repeat people, but it's cool to see new faces. We've been doing this for what, 4 years now?
4 or 5, I think.
Yeah, 4 or 5. And
Yeah.
Thomas spoke at like about 2 years ago.
Yeah, so it's my third time, I think.
Yeah, that was a great one. And we learned so much that we had to have him back. It's kind of like a podcast, right?
Yeah.
So we'll save, geez, we definitely hear an echo, but we'll save our questions kind of till the end and kind of
Does he have a mic?
technology we're still learning. Yeah. And then let's go over, like, since it's a new year, 2025, who's got like some big real estate goals they want to share that they're trying to accomplish this year? Because we're all about like setting goals, but also helping people achieve them. So if you have a property you're looking for, if you're looking for private money, lending, setting up an LLC, someone can help you. If you're looking for tax advice, someone can help you. It's like we're all about like helping you achieve your goals. So anyone want to share?
Looking for private lending potentially. So
Okay.
maybe talk to you about that later.
Okay.
In terms of goals, this is not necessarily investing, but it's investor adjacent. It's setting up a corporate housing arbitrage business. I just had a breakthrough, and we're signing leases in Chicago for properties, and
Nice.
really excited about that. Kind of the poor man's way to get in the game, but you know, you gotta get what you can take. But then eventually want to use the cash flow to purchase and buy and manage short-term rental and long-term rental real estate assets. So got good long-term goals. I'm just getting started up and running, and have a potential short-term rental purchase deals, but yeah, I need to figure out private lending. So I'm going to talk further about that.
Sweet.
Awesome.
Way to go.
I love that. See, I didn't even know that existed,
Yeah.
like arbitrage.
A 4-plex, 5-plex, or a 4-plex, something like that this year.
Where at?
I don't know, Paso, I don't know what it would be, just around here. I don't wanna go far.
Nice. Very
Awesome.
cool.
I might have a triplex. I'm willing to like we'll see for
Yeah.
the right price.
7
Anyone else? Anyone else? I mean, we are at a real estate like investment.
We've got kids that are starting to enter the college stage, so we're looking at doing some kids rental properties in SLO for college kids.
Nice.
I know one on Broad. Someone has that.
There's
one.
a duplex. They just dropped the price.
Dude.
It's like beautifully remodeled.
Something that-
Crazy. You could roll your commission into it.
Yeah,
One
Sean.
thing on that, if you add your actual child, if they're over 18, they actually, so you want to get them on your credit cards and do the credit history, then they can be owner occupied and get people financed.
Good call.
There we go.
We call it kitty condo.
And you did say slow and cash flow, and I don't know if those.
It's like maybe break even for like the first 2 years.
We would do like break even at year 4. We'd be okay
Nice.
with that, but not like killing ourselves before that.
Sean could probably run you like a break even like calculator. I don't have one of those.
I do agree though that getting the kids on the credit card is a great idea. Not every credit card actually builds the kid's credit though, so you have to make sure that you get the right credit card.
Give me a credit card too. Anyone else got some something they've learned or something they're dealing with investment wise?
Okay, so we just hired a property manager for the first time ever. We've always self-managed property and it's been great, but this is amazing. It's so turnkey. It's actually called Turnkey Property Management. It's the name of the company.
Yeah.
And it's so nice. Like you don't have to do anything. They leased up the building 75%. I never had to show it one time. And we need one more tenant and then it's 100% occupied. So it's been great. So property management, and this year it's all about like stability and, paying down what we have and just focus on fixing it up, making it better. So pretty simple this year for
What are they
us.
charging? 6 to 8?
Yeah, they're in that range. You know. It's negotiable. You gotta talk to them about that.
Percent, 6 to 8%.
Yeah,
Yeah.
of the gross rents. That's usually.
Million.
That's brilliant.
That's pretty low. That's pretty low.
That is
Yeah.
good, yeah.
Right.
It's kind of our market. If you go to the valley, it's like
10%.
roughly 10%.
10 to 12 some other places, so.
The rents are less.
And then if you're doing short term, it could be anywhere from 15 to 25. Cool. Well, let's get started.
Okay, and yeah,
Really
Tom
good.
Cook, by the way, CPA, local legend. This guy has helped so many people save a ton of money. Before we got connected with Tom Cook, we were always ending up paying extra in taxes, and we're like, what?
What were you doing that?
What was the CPA doing? Like, hold on. And then when we started with this guy, we get tax refunds every single year, and he's helped us tremendously pay less in tax, save, and invest more. And so please welcome Tom Cook, CPA.
I think this is my third time. I enjoy doing it. We had the idea of, well, first of all, getting into it. Owen introduced me a little bit. Tom Cook went to Cal Poly, graduated, one of the oldest people in the room, 1991. Moved to Bay Area for 10 years and then decided that I did not want to raise my kids in the Bay Area. Pleasanton's nice, but parts of it are not. So my ex-wife and I went to Cal Poly. We looked at Arizona, Washington, we looked all over the place and decided, you know what? If you're gonna be in California, San Luis Obispo area is the place to be. So moved down here in 2001, and then I bought a firm in 2003, and I've been doing that ever since. So started doing, the firm I bought did auditing, so if you had a business and you need audit, we would do that, government audit, bookkeeping, payroll, tax. 10 years ago, I got rid of the audit. I didn't like it, because really, you can't take your client's word for it. You're auditing somebody, you ask a question, they give you an answer, like, really? Really? Can you prove that to me? Versus on the tax side, you know, if you give me an answer, good enough for me. If you're gonna lie to me, don't tell me. But if I find out later you lied to me, our relationship's over. But I don't want to question you if you give me an answer. So I like that trust. I like that relationship. And I enjoy doing it. We do bookkeeping. So we like doing, mostly taking over the back office. So the owner doesn't have to do anything. We try and do as much as we can. And then tax prep and planning. That's what we do. 5 city CPAs. And then the hope was to maybe talk about some tax law changes, but nothing's really happened. I mean, we know something is gonna happen, and down here, I've got, towards the end, if we have time, we can talk about some of Trump's proposals. Don't want to spend a lot of time on it because they're just proposals, and most of them won't go anywhere. Some may, but most won't, at least not in the form they're in. So jumping into it, one of the ways, does anyone know about depreciation? Okay.
It's definitely.
Who doesn't know about depreciation?
Love it.
All right, so depreciation basically, for those that don't know, is you buy a property for $1 million. You have to say how much is land, and you can look at your property tax bill for an idea. 500,000 is land, 500,000 is building. If it's a residential building, you get to deduct that over 27.5 years. Not very sexy, long time to recover your investment. That deduction, you get to lower your taxes by the amount of that deduction, 127.5 every year for 27 years. Lowers your taxes, doesn't cost you money, it's a deduction you get without paying for the deduction. I mean, you pay for it about the building. So that's called straight line depreciation. Go ahead.
Can I ask a question?
Yeah.
So I just finished building my house and I'm in it, but I don't own anything on it. How does it work like that? Cause I paid for it as I went. So how do you do that?
So you know what you paid for the land, right?
Yeah.
And then you know what you paid for the building.
Yeah.
So
Just those receipts or?
yeah, your records, whatever you come up with when you add up everything you spent on the house, other than the land, and I'm being general, other than land, is a depreciable asset. Not for your house. If you moved out and rented it to someone else, that you can depreciate it then, but you can't depreciate your own house in general. Home offices and things like that, you can portion of your house, but your residence, not depreciating your residence unless you move out or you do an Airbnb and you just rent a room in your house, then you can depreciate part of your house. But in general, your house, no. Rental property, yes. Residential property, 27.5 years. Commercial property, 39 years. Call it 40 years. Just think 30 years and 40 years.
Well, if you have a 3 unit or a 4 unit, you become owner occupied, so you get a residential loan in effect. So say it's a 4 unit, the other 3 are depreciated at
Yeah.
1/27th, or is it considered commercial even though it's not a commercial property?
No, it's residential.
It's residential, so
Yeah.
you only get 1/27.
Yeah, that's round numbers for 75% of the building cost.
Okay.
So that's kind of what you're stuck with. Ground level, buy a property, you have to allocate land, can't depreciate land. Building, you get to depreciate building 27.5 years or 39 years. So there's this thing called bonus depreciation that's gone up and down. The percentage has gone up, down, up and down, up and down. There were a couple of years there where you could get 100% bonus depreciation. So to think about it, you buy a building, residential, your 3 units, 27.5 years, you're chugging along, not very sexy, consistent, you can predict it, but it takes a long time to get that back. So that's because a building is 27.5 years. This building is 39 years, long time. So what people will do, and I'm kind of getting into cost segregation, is you can pay someone, anyone know a company that does it? But you can pay somebody to come in and look at your building. You'd be different because you built it, so you might have the data already. But anyway, if you buy a building, pay a company to come in, and they break it down into components. Well, this, we have a water heater over here. We have, just imagine all the different components you could break a building down into. Then outside, they can look and say a sidewalk. You were writing that off as land. Well, that's a 15-year asset. That sidewalk we can write off over 15 years. This in the building we can write off over 7 years. This we can write off over 10 years. And so they'll go through and break your building down into pieces. And anything that's still building is still 27.5 years or 40 years, 39 years. Long time. Anything they break down into 7-year, 10-year, 15-year, you could write off over 7, 10, or 15. Great. Still better than 39 or 27.5. You get your recovery. You recover the cost of your asset faster. But with bonus, that 7-year asset, 10-year asset, 15-year asset, you can write off first year. So you can save a lot of money with bonus depreciation. You might pay one of these companies, I don't know, $3,000, $4,000, $5,000 to do one of these. But you can recover, instead of 27.5 years, you can recover, I'll make up a number, $100,000 of your full 500, $1 million purchase, 500 land, 500 building. If they could take $100,000 of that 500 and you could depreciate it today, that's a pretty big tax savings, day one. Yeah.
And that's all under the title of a bonus depreciation.
Bonus depreciation, right.
Okay, got it.
Right.
And you said that's random, is that every year, or is that?
It's gone up and down. It was 50% and then it went away and then it came back. It all depends on who's in office and what happens and the election.
There it is.
So in 22, it was 100%, 23, 80%, 24, 60%, 25, 40, 26, 20, and then 0. So the appeal of it is going down, but this is a big item for Trump to restore this to 100%.
Because he was 100% when.
Right. Yeah. So it was 100% before 22 as well.
Yep.
But the idea is it encourages people to spend money to buy things. Real estate is kind of the afterthought. It works for real estate, but really it's about companies buying machinery, equipment, vehicles, all of that stuff to keep the economy going and buy, spend. But somebody said, hey, let's apply it to real estate, and it works. But you kind of have to get this cost seg study done that allow you to break your $500,000 in pieces and then depreciate that over. If you don't do bonus, great, you can opt out of it. You don't have to do it. You're still taking 27.5 or 39 years and depreciate over 5, 7, 10, 15, which is way better. Or you could decide to do bonus and take this year, touchscreen, take 40%. If you bought it this year, did the cost seg study this year in 2025, you could write off 40% of whatever you said had a shorter life. Still better than not.
If you've already been straight line depreciating it for, let's say, 5 years, can you all of a sudden go and do the cost seg, or
Yes.
does it have to be done right
Yes.
away?
Yeah, you can do change it. It's called a change in accounting method. Add some dollars to the cost seg because it's quite a bit of work for the CPA to do. But yeah, you go back and you can in 1 year, you can kind of recoup a lot of that you didn't get in the prior years, and then going forward, it's gone.
The cost seg isn't actually somebody going in to validate something, it's just your accountant taking that strategy.
No, it's a separate firm. So
It's a separate
it's an
firm.
engineering.
And if you guys want referrals, we can.
Yeah, it's an engineering firm. The bizarre thing is they can do it without ever stepping foot in your building. There's firms that do it without ever coming to see it. It's virtual. And so it's, on the front end, building a property, you could pay somebody. If you were building a massive commercial property, you would pay somebody during that process to do the cost seg as you went or ahead of time versus after the fact. But if you're buying a property, you have to pay somebody to come in afterwards to break it into pieces for you. Yeah.
So on that same property I was talking about, it's an acre, and the back half of it, I keep a lot of my equipment and stuff for work. I mean, is there a way I can rent it to my construction company or?
But it's just
something like
land.
that? What's that?
It's just land.
Land in a garage. Yeah.
I mean, you could rent it to yourself, but you'll have income on the rent, which you're creating income that you
Didn't have.
had before.
Yeah.
Um,
So it wouldn't offset enough to
yeah, I
do
mean,
anything.
we could talk later, but I mean, if it's a business would be the deduction. You report the income, so that's a net. But then you get to write off the garage in depends on the cost extent. Garage door, write that off over 7 years instead of 39 years, because that's commercial at that point. So probably not worth it unless it's a massive garage. But, so that's the idea of cost seg, recouping some of your investment today versus tomorrow. I will try and talk people out of this, strangely enough, because you have to have discipline. If you have an asset you can ride for over 27 and a half years, that asset is going to be able to, that depreciation is going to be able to help you reduce your income over 27 and a half years. That's something that's nice to count on. I mean, that's a nice deduction you can count on every year. So if you break that into pieces and write off a bunch of it today, you're kind of screwing yourself for the future, right? Because now you don't have that deduction in the future to offset future income.
Unless you keep buying properties.
Unless you keep buying properties, right? So what I'll do is I'll do it with and without. So if you're gonna do it, here's how much extra refund you're gonna get. Take that money and invest in another property. Don't buy a car. Don't spend it on vacations. Because you're really hamstringing yourself for the future by taking that deduction now. So take the savings from that and reinvest it somewhere in something, but don't spend it because you'll regret it later. So you have to have discipline if you do a cost seg study.
If you're exiting out of the building at 27 years length, say you're in the 23rd year of it, you can add that expense back in to create a new basis, right? So it'll minimize your gain. Is that true?
Once you take the depreciation, it's gone.
Okay. I was under the impression, you spend 40 grand on a roof
Yes.
and you're using 1/27 of 40 grand each year.
Yep.
5 years later, you sell it and you haven't depreciated off the whole 40.
Right.
Doesn't that help reduce the basis?
Yes.
Okay.
So-
It does help your capital gain.
Right. So in addition to giving you deductions in the future, if you just take it over 27 years, you're also providing cushion, insurance, whatever, that if you sell it, you're gonna have a smaller gain because you still have basis left. If you write off the basis up front, bigger gain later. If you sell it and don't do a 1031 exchange, which you should do a 1031 exchange if you can. Don't give the government money if you don't have to.
Would that be considered the same thing as a recapture?
That's recapture. Yeah, it's called recapture.
Yeah.
The government wants to recapture the deductions you took earlier. Questions on that?
Is Starker Exchange still 90 and 90? 90 days to find, 90 day to close,
It's 45 and 180.
45 and 180.
Yeah.
Okay.
Yeah.
When I did it was 90 and 90.
Yeah, and it's, gotta use the intermediary
Sure.
and go through all that. You can't touch the money until it's done. It's kind of a no-brainer. If you leave California, gotta love California. I moved to Tennessee and just moved back. But if you sell a property in California and you do a 1031 exchange to another state, forever and ever and ever, until you sell that property, you have to file a form in California every year telling them that you still own that property.
Wow.
Because if you sell that property, You move the money, you move the gain to Tennessee where there's no state income tax.
They want it.
Yeah, they want the gain that you deferred in California. If you sell it in a taxable exchange, you can exchange it again and again and again and again. Stuff by the form in California telling you still own this property, I still own it, I still own it, I still own it. But if you sell it, I'm waiting for someone to sue. I think that's illegal. I don't think it's right. I think it's similar to somebody who lives in California their entire life, works for PG&E, works for county government, works for somebody with a pension, right? And so they retire, they move to Tennessee. California can't tax all that deferred income. It went to the Supreme Court, they can't do it. If somebody lives in the state, they defer all of that income tax-free, then they move to another state, California can't tax that when they start pulling out that retirement income. So I think this is similar, but no one's sued yet. And this is just an example of tax benefits, but it's just too small to sue.
Let's go together on this, guys.
I'll just vouch for that program is like doing cost segs. I've probably done about 10 of them, and I've literally like not paid taxes in a lot of the years. So
Right.
I would highly recommend it. Although I see what you're saying is that if there's negatives and consequences, like if I'm going to resell something,
If you're gonna sell a taxable sell, you're gonna pay later. So it's buy a property every year.
Yep.
Do a cost seg
Or a
every
few.
year. Yeah. So for the next 40 years, just buy property every year and you'll be fine. This is an example of the cost savings on a cost seg, but it's too small to see. So strangely enough, today I received an email from the Tennessee Society of CPAs, which I am a member. There's a class, February 28th, maximizing tax real estate incentives with cost segregation, 179D and 45L. I have a flyer if anyone wants to go. It says free. It's free for me because I'm a member. It's $30. But if you want to do a webinar at the end of the month and deep dive into some of these topics, then I have a flyer over there for you to take and enroll if you want. Let's see, what is this? So I think I heard attorney or paperwork, filing LLCs, doing that kind of stuff. So who in the room has an entity that was formed to the California Secretary of State or any Secretary of State? Okay. Does anyone know about the beneficial ownership reporting?
Yeah.
Does anyone not know about beneficial ownership reporting that has an entity? Okay, so if you have an entity that is registered with any Secretary of State in the country, LLC, corporation, limited partnership, the Treasury Department said, starting this January 1st of this year, that you have to file a report with FinCEN, that's the Financial Crimes Network, telling them that you own the company and a bunch of other personal information about you. And if you don't do that, if you didn't do that, there's a $500 a day penalty for not doing it. So that was supposed to take effect. The law went in January 1st, 2024. The filing was due by January 1st, 2025. December 3rd, somebody sued, it was put on hold. December 23rd, it was reversed, went back into effect. December 26th is on hold again. It's still on hold. It's still on hold. So
I thought so.
I am reluctant to give my information to the government if I don't have to. So it's on hold. And today again, just this evening, I got an email that the House just passed a bill to extend the deadline for another year while this all gets kind of worked out. It was unanimous. No one dissented in the House, which is incredible. So to go to the Senate, I imagine it'll be the same thing. President should sign it. So another year to deal with this, see if it applies to you, doesn't apply to you, should not apply to you. I mean, there should be exceptions. What they're trying to do is really crack down on money laundering. And that's the goal of all of this. But it's just a huge invasion of privacy. So if you didn't know about this, put it in your list for December 2025 to check back in on. And most CPAs won't help you with it. I turn people away. It's like, talk to your attorney because this is a legal thing. Because you get into ownership structures and beneficial ownership. Maybe you don't own it directly, but you own it through this relationship or this ownership over here. So, it's really kind of practicing law. So a lot of CPA firms are like, I'm doing it. Any questions on beneficial ownership report? No, super important.
That's a good question. Can you address that? Cause I had my attorney reach out about it, who set up the entity, but then I also had your firm reach out. So who should?
So we're very clear in our communications. We'll send out email blasts. We're very clear. We're not doing this. We are not,
Got it.
don't ask us questions because we're not helping.
We just filled it out. We're just like, screw it, well.
Yeah. Yeah, it's not complicated for most of you in the room. I own the company. I'm the only owner. It's one class of stock. No one else has an interest. Pretty easy. But if you start getting into multi-ownership, trusts, complicated ownership, have an attorney do it or help you.
Even trusts?
Trusts, so trusts are not an entity subject to beneficial ownership reporting. But if your trust owns an interest in an entity, it needs to file.
Got it.
Yeah. And so the entity, you need to file as the owner, right? So that's kind of how it works. So who borrows money to buy real estate? All right. So sometimes you might borrow money and use it for different things. I borrowed money, $100,000. There's an example up here. This is called interest rates. I borrowed, in this example, Bill took out a personal loan of $150,000. He used $100,000 as a down payment on rental property and $50,000 for whatever. Interest tracing says from that one loan, the $50,000 actually was to start his business. From that $150,000 loan, you deduct the interest on $100,000 on the rental property, and you deduct the interest on the $50,000 to start your business in the business. That's interest tracing. So you can take out one loan and use it for different stuff, but on your tax return, you're supposed to deduct this part over here and this part over here. It's pretty cool, right? So, and that's what you're supposed to do. But a lot of people can't get $150,000 unsecured loan. I mean, 20% interest, 25% interest, 30% interest, maybe. But most people can't just go and borrow $150,000 without collateral. So where are you going to borrow from? Rental properties? Yeah, rental properties. Same rule applies. Borrow from rental property. This property, take $300,000 cash out refi to buy a rental property over here. That the interest on that $300,000 gets deducted on the new property, not the old property.
Oh, say that again.
So if you have a rental property, and it can be free, it can be paid for,
Right.
and you do a $500,000 cash out refi because you want to buy a new property. Use that money, equity.
We did it.
To buy a new
I'm trying to see
property.
Where your interest is getting recorded.
So you're supposed to deduct the interest, even though it's secured by property A, the 500,000, you're supposed to deduct the interest expense on property B, was it used to buy it? Yes. Yeah. So.
That's what that amendment was all about. And it was on the wrong property.
If there's a mortgage on that property, or what happens if you
No.
bought it for 500,000?
So you took, this was paid for, A is paid for.
Yeah. And then
Worth
you
$1
took
million
the
bucks.
500.
You took
Cash.
500,000 out and you bought a property for 500,000 cash. I'm sorry. Yes,
Still works.
yes, yeah. So 500,000 loan over here, you just pay cash over here. As weird as it is, you deduct the interest on the one that you paid cash for. You don't deduct it over here. You deduct it on what you
Now, where
use the
you
money
borrowed
for.
it from.
Right.
What's the purpose of that?
Interest tracing, I don't know. Talk to your congressman.
Okay.
So principal and interest go against the property that it was applied to. Not where it
Principal
was
doesn't,
taken-
principal
yeah,
doesn't,
Not where it was taken from. but-
yes. Yeah. So, you know what?
Popular when everybody was grabbing the equity lines and buying RVs and all the other crap.
Right.
This is when the government got heavy into it.
Yeah, and it's been around forever. But in the boom, people were borrowing from this and buying that, and tax returns were crazy. It was really crazy to keep track of.
So like we refinanced our house and paid off 2 properties that were rental properties. Then one of them went from being a rental property to a second home. Or does the interest get deducted?
So part
And because you only get $1 million on your home, that's why it's kind of,
750.
yeah, well, whatever.
Yeah,
So
yeah.
because of that rule, so now we can take that interest to the next property?
Maybe not. So it gets complicated if you borrow from your home. For most people that are getting started, that's it. I own a home. I have equity in my home. I need to tap it. I want to buy something. So the only way you can write off interest on your home in your tax return on your Schedule A itemized deductions, if it's your primary residence or second residence, total debt of $750 federal, million California, and it's used to buy or improve your property. So that's the baseline. If you want to deduct interest on your Schedule A for a home mortgage, you have to borrow the money to buy or improve your property. Period. Federal's $750,000 limit for the loan. California's $1 million. I'm just gonna leave it at that. That's kind of a new thing. It may go back to $1 million with Trump. Who knows what's gonna happen? So if you borrow money against your home to pay off something else, that money was not used to buy or improve your home.
Right.
So you cannot write it off on your Schedule A home interest expense.
That makes sense.
Yeah. So there's something called a 10T election, which allows you to maybe write off some of that on another property, the one you bought. It's a little too complicated to get into right now, but just know that you can borrow against a rental, no problem, as long as you buy something over here to deduct interest over here. You can't really borrow, don't think about borrowing against your home and deducting it as home mortgage interest. There is a way you can deduct some of it or all of it as rental, but it's, again, too complicated to get in here. I have this example I can email to anyone who wants to see. So, questions?
Private money.
Private money is awesome.
How's that?
Same rule. I mean, because
So
there's
you give me $100,000,
secured
interest
by,
only.
secured by.
Okay, as long as it's on, so, and unsecured, it doesn't matter. If it's,
Yeah, unsecured doesn't matter.
yeah.
Yeah, if you know somebody will do that, let me know. Give me the name.
I know you.
Call him right now. Sean, you do unsecured loans?
I like Social Security.
Yeah.
Here's why we've been around this.
Yeah. Yeah, but it's what it's secured by. So, but again, you're gonna run into it. I mean, you're in real estate, you're gonna run into it. You need equity. And that's where you're gonna get it a lot of times. And yeah, it might be a bank, might be hard money. But it's what it's secured by that matters. So, right? So one person has, quite a few people have entities. Raise your hand again if you have entities. All right, so this is just my accounting advice for you guys getting ready for taxes, make it simple. If you have an entity, you should have QuickBooks or you should have something like that. You just should, period. If you don't, fine. But if you do, try and put your mindset as the owner, as you're the employee. You should, if it's a corporation, you should be on payroll. If you're not, still think of yourself as the employee. If you've ever worked for a company or a government entity and you spend your money on your boss's, the company's stuff, you would submit an expense reimbursement, right? I would be reimbursed for the money I spent driving, going to dinner, doing this for you. It's your company, but I spent my money on it. You'd submit an expense reimbursement. That's the same mindset you should have as a business owner, especially if it's an entity, is you're an employee and you should be submitting an expense reimbursement for things. A little bit of extra paperwork, but it'll protect you in the end. And it's just a good mindset to be in to help you remember that the company's money is the company's money, my money is my money. They're not the same thing. It'll keep you out of trouble long-term. Just a little advice. All right, so Trump's tax proposals. Make individual TCJA cuts permanent. So that is everything he did and put in place. A lot of it is tax rate structures, itemized deduction changes. The one thing that he says he doesn't want to keep is the SALT tax limit. And most people in this room, if you own a home and have a job, you're probably running into this new SALT tax, the SALT tax limit that he put into place. So what that means is on your Schedule A itemized deductions, it's about in the middle. It's the taxes you get to deduct. You get to deduct the taxes you pay to California. You get to deduct the taxes you pay to DMV. You get to deduct your real estate taxes. So it used to be was the total, whatever you paid, that was your deduction. $40,000 for something. When TCJA came in, they limited it to 10. And this is one of the few things I've ever seen where it's 10, whether you're single or married. So that's kind of weird. So that's the one thing that he'd like to eliminate is the SALT cap so that you can go back to deducting all of your taxes. Because if you think about it and you bought a home anywhere in the Central Coast in the last 10 years, your property taxes alone are going to chew up a lot of that $10,000. So you don't get to write any of your state income taxes or any of that. Very expensive for him to get rid of that SALT cap. So I have to see where it goes. It was really, when he put it in, it was really, people really thought it was his way of punishing the coastal states because they have the highest property values. They're more blue than red, but he is interested in getting rid of it. Wants to lower the corporate tax rate, and this is for C corporations. S corporations don't pay anything to the feds. So this is for C corporations, lowering it from 20% to 15%. Anybody have a C corp? No. Oh, Sean, they're pretty rare these days. At 15%, you might see a lot more people putting them in. But the problem with some of this stuff, and you know it or you will know it, is making a major decision to go C corp versus S corp for a 10% spread because somebody got elected. What's going to happen when the next guy comes in? I mean, are you going to base your structure on something that's temporary? So that's really difficult to make that kind of a decision. But a lot more people will start looking at C corps if they do lower the tax rate to 15%. And a C corp is different from S corp. S corp, all the income flows through the owner. The owner pays tax on it. C corp, the corporation itself pays the tax. Writes a check to the federal government for tax. Universal 20% tariffs. Who knows? Don't know what's going to happen. But the argument is that's going to help pay for loans, right? Because in any of these tax law changes, it's about they're supposed to be balanced over the long term. Is it going to add to the deficit? Not add to the deficit? What's it going to do? They're thinking that the tariffs are going to offset a lot of the expense of these tax law changes they're talking about. Exempt overtime pay and tips from federal tax. I don't know. It'd be a nightmare having somebody that's done payroll.
Mhm.
So they'd be exempt from federal tax, but not state tax. If they're exempt from tax, does that mean they can't be considered as compensation for deferring into a 401k plan or a simple plan? I don't know. So then you have
qualify for a loan.
or to qualify for a loan. So
Mm.
it's sexy when you're running for office, gets people excited, but is it practical? And taxes on Social Security. So anybody here on Social Security, don't answer if you don't want to. But if you have Social Security, and the biggest one I've ever seen, I think I just saw it because there's been big increases the last couple of years. Somebody had $58,000 in Social Security, one person. Not bad, right? So at the base level, Social Security is not taxable. If that's all you make, that's it, you don't pay any tax on that. As soon as you start making like 30,000 or more in other income, your Social Security starts becoming taxable. So this person had other income, but no more than 85% of your Social Security will ever be taxable. So, this person, $58,000 of Social Security, other income, 85% of their 58,000 was taxable to them. So this is talking about making that person's taxable Social Security not taxable. At the base level, if you're on if you're subsistence living and Social Security is it, you're not paying tax anyway. You only pay tax on Social Security if your income goes above 35,000. So this is really about helping. It's gonna help people with high incomes more than low incomes. So we'll see what happens there.
Is it because it wasn't tax going into Social Security? So the
It's
tax
just-
on the way out, kind of like a 401k, or is it?
I think it's just more of an equity thing. I don't know. It's been around forever. I'm not sure what
So
the
it's always
rationale is.
taxed it. But
Well,
is it
it's
like
never
double
the tax.
tax?
It's always,
Does that make sense? Like
yeah.
you
If
get
you-
paid
if you-
a paycheck, you're
If you would
paying.
consider that it's your money,
Well, I mean, eventually it will be, hopefully.
right? But it's not set aside for you in an account for you. But that's a good point. Never thought about that. But at base level, not taxable. But when you start making any kind of reasonable other money, it becomes taxable. This would eliminate that taxable Social Security for people that make a decent amount of money.
It's also so that the working class don't have to leave their jobs, was one of the other arguments you got to, because if somebody's been in their position, they're getting social security, they have to stop at a certain level and say, I can't work anymore
True,
because I'm double taxed.
right.
But that's the other thing was our workforce is gonna be older, so they wanted to keep it,
And that's a good reason. That's a good reason. So I don't know if you follow what he's talking about, but if you're drawing social security, you draw early, which everyone in the room may or may not have to make this choice. You draw early, you can only make a very small amount of money in other things, working wages, or they'll take their social security back. We're gonna give it to you, but if you make too much, we're gonna take it back. And so if they incorporate that into, and what Sean's saying is then people work less. They want to work more, but they don't work because they don't want their social security to be taken back by the government. So if they can incorporate that into this, then all those people that are holding back and only working 5 hours and want to work 20, they'll be available to work 20 hours.
That's kind of negotiable though. So like on the hours they are working, they're still paying into social security,
Yes.
right?
Yeah.
But then they're saying you can't have it because you're making too much.
Yes.
Even though they're paying more into it.
Yes.
So yeah.
and once you make the distribution,
Government
you can't
doesn't-
reallocate, you know, taken away from you, you don't get the higher amount.
Yeah,
Just you would help out.
I don't actually do a lot of consulting in social security. It's complicated. I don't know a lot about it. Social security admin, your parents drawing or about to draw, go talk to them. They'll sit down in computer programs. They can run scenarios like, what if I retire this year? What if I retire next year? What if I draw on my spouses now versus drawing on my spouses later? What about if I draw on my divorced spouse or my deceased spouse? There's all kinds of scenarios that I just don't feel. So I don't know. Estate taxes. Anyone know about state taxes? I mean, our goal is to accumulate wealth, right? I think Owen said real estate's the best way to accumulate wealth. The goal is to accumulate wealth, presumably to pass on to someone else. And so if you want to do that, the way the government can get more money from you is if your estate, when you die, is worth more than a certain dollar amount. When I was a kid, and I think from the very beginning of the estate tax, it was $600,000. If your estate was worth more than $600,000, your estate, after you die, was writing the government a check for a pretty hefty percentage of that dollar amount. Then it went to $1 million, and then it went to $2 million, and I think now it's at $12 million per person. And that was part of the TCJA, is that they bumped it up to something that approximates 600,000 when 600,000 went into effect in 1950 or 60. So it's a very high number, but it's set to go back down to something, I'll say like 3 million next year, 2026. And so part of it is to reinstate that and keep that permanent, keep those higher limits, which kind of seems reasonable. And then, yeah.
So you're saying 12 million cap per person or 15?
I don't know the exact number off the top of my head.
It's 12
Okay.
per person, so 24 total.
So it's
Yeah.
12, so 24 million, but is that on paid off assets or
So
what
when
happens
you-
if
so when you
it's 10
die-
million in
so
real
when you
estate,
die-
there's loans on it?
So when let's say you're married and both at the same time, just to make it simple. You hire an appraiser and everything you own will be appraised. If you have old cars, those will be appraised. If you have artwork, that'd be appraised. Everything is appraised. There's a form, if you can imagine, everything goes in the form. And then you bottom number over here for a married couple, in Owen's example, 24 million. As long as it's less than 24 million, your kids get it. No tax, no estate tax, right?
Minus loans though.
Well,
I guess that was my
someone's got to pay this off. So the loans will go into, the loans would affect value.
Yeah.
Yes,
So
they're
the
offset
equity,
to
it's
value.
about the equity.
Yes,
Yeah.
well,
It's kind of like
Fair market value
a personal
minus-
financial
Times
statement.
debt.
yeah,
So if everything's in a trust, it wouldn't matter one way or the other, that still happens.
yep. They want their money.
I had a client recently, okay, I don't know if I'm gonna say this right, so mom passed away, they inherited the property. They did not move into the property as their primary residence, so their taxes
Right.
went up by like 12 grand the next year.
So that's a different thing.
That's in California.
So, yeah, so the way it used to be, well, let me finish that discussion. So the other part, those in the room that, don't know much about state taxes, when in that example, the 24 million, two people die, let's say it's right at 24 million. Let's say 20 million of that was real estate. and let's say they had owned those properties for 40 years, fully depreciated. They paid, you know, 3 million for them over the years, and it came worth 20 million. So that's a huge gain, right? I mean, that's a huge gain that there should be tax on. The whole goal in this is defer 1031 exchange, defer 1031 exchange, defer 1031 exchange, and then die.
Yep.
Because when you die, all of that gain, and all that depreciation goes away. So your kids get $24 million worth of stuff with a basis of 24 million, they could sell it the next day and actually, yeah. And actually, if they're rentals, they could take a loss because they're gonna have realtor fees, they're gonna have commissions, they're gonna have all the escrow charges. So they'll actually have a loss on the sale if they sell it. But, so then you're talking property taxes. So for a very, very long time, you could inherit your parents' house and there would not be a step up in basis for property tax purposes. That has changed. The limit is $1 million, I think, now, of value that can go without an adjustment, and you have to live in it. Before you didn't have to live in it, now you have to live in it.
Within
How
a
long?
year?
A year.
No,
I
I
think-
assume so.
It has to
reside there prior to.
No, no.
Oh, okay.
No.
No.
Sean, do you know more than me?
Another piece on that, if you are residing there, if your parents gave it out as a multiple to multiple people and didn't give it to you only, sometimes you have to do a loan in the trust so that you can redistribute that you're getting that percentage of the house yourself. And you're getting the house and you give your sibling the money, because if not, then it's prorated by all the people too. County of SLO is allowing it just as long as you're on the title and letting it fly right now. But there's been 2 lawsuits about that.
And you
Because
guys-
they said you only own a third, so you only get a third of the step up protection. So you just want to be real careful with that. But SLO has been very gracious
Wow.
compared to the most.
Yeah, and you may not share my opinion, but I think we have an awesome appraiser. I think
He's great.
our office is amazing.
He spoke at one of these meetups.
If you have,
Assessor? Or-
Tom Bordenaro.
yeah,
Or-
if you have,
He's good.
if you have questions, call them, they answer the phone. Customer service is off the hook for a government agency. So, don't be afraid of them. I mean, I won't call and tell them my name, but, or my property address, but, you know, hypothetically, and they're careful, they won't, you can't pin them down on exact things.
Mickey
but-
Mouse is calling again.
Yeah, yeah. So I think that's really all I have. I can open questions. This is the dollar impact of some of these things we talked about. You know, he wants to, he wants to create a deduction for auto interest. Yes.
So between the S Corp and an LLC, which was your preference?
S corp. And does anyone wonder why? Or
Over a certain limit, right? If you're making below 70,000, right, it's kind of just go with the normal LLC.
it depends. Depends.
You're gonna
So-
give the owner more protection if it's.
No, there's no difference. I'm generally not a fan of an LLC for tax purposes. I don't think, an LLC does nothing for you for tax purposes, does nothing. So an LLC is a great way to own a property. So that's a differentiation here. So as a business, S corp all the way. As an owning property, LLC all the way.
Good.
Because every dollar an LLC earns in general, as a per business that flows through to you as the owner, is subject to self-employment tax. The same as if it wasn't in an LLC. So for a business, an LLC does nothing for you for tax purposes, nothing. Doesn't help you, doesn't hurt you, gives you liability protection, but tax purposes, an LLC is nothing for tax savings. Flip it to real estate, do not buy real estate in an S corp. Don't do it. It's a mistake. It depreciates inside the S corp. When you go to liquidate it, you're gonna trigger tax twice on the transaction.
Can you dive into that? Because I've discussed it with my CPA about buying flips only, because
That's
only something that we're not gonna hold
Yes.
longer than a year.
another clarification, yes. So if you're in the business of doing flips, that's fine. If you're in the hold property long term, I would not do it in this.
Okay.
Yeah, Because then that's gonna be self-employment income.
Yep.
If you do flips and you kind of pay an extra self.
That's the only reason we're doing it, because like I'm buying in a separate LLC right now, which is not an S corp, and then I'm getting taxed, right? Where if it was in the S corp, it's kind of semi-protected.
Yeah, and anyone not following, have questions about that? No. Yeah.
I just have a follow-up question. So I have 9 different entities
Uh-huh.
and 6 of my their mobile home parks are in Portland and Washington, or Oregon and Washington.
Okay.
And so I live here, the business is in Oregon and Washington. Has nothing to do with California, but I have to pay a filing fee in California. It's my primary source of income is the property.
Is it filing fee or an $800?
The $800.
$800, yeah.
So I have an LLC. Is that correct?
I might fight them on that a little bit.
Yeah.
Depends on if you
Tax
have,
stuff if you do 8.
if you are more of a hands-off owner,
Yeah.
I might fight the $800. If you're actively involved in the business, I think you got the $800.
Yeah, because I mean, I do the flips, we're replacing our lines and all of our electrical components and all that kind of stuff. So I'm involved in that capacity,
Yeah.
but
I think if you're actively involved in the business, you're stuck with the $800.
okay.
Does it matter if she formed them? Is that what you're saying? You
They're-
formed them
they're-
in California or they
the-
formed them?
So the properties are in a different state and all the businesses in another state.
You formed the LLCs
Mhm,
in that
formed-
state though?
Yeah,
Okay.
formed in that state, but you still have to pay a filing fee in California for living in California.
And we call it the callback fee.
Yeah,
Yeah.
They just call everything.
I just learned about that.
Yeah, and it's unfortunate, and there's been lawsuits that have gone for years with the franchise tax board. But in general, if you're in California and you're actively involved in running the business, then you're gonna be paying $800 a year for that entity.
Yeah, but then you own 8.
Yeah, and that's not all though, but then you gotta pay tax,
Yeah.
tax filing on each one and it's.
Yeah.
So 8
Yeah.
times 2, because we
Yeah.
pay the state for the properties in and the state of California.
Well,
You got a tax
those
credit.
states probably don't have it.
Yeah, there's only 100 bucks.
Yeah.
Yeah, they're still chill.
Yeah, it's,
Wow.
I learned about that last year because I hadn't been paying it up until last year, and I was like, that can't be possible.
Yeah.
They're there, the entity is there.
That's.
We got told if we made a phone call, we were screwed.
yeah, it's,
There's a property management company that does everything for you and they just send you a check. Similar to like, one of the
Yeah.
shared partnerships or something like that.
Yeah.
Then we didn't have to worry about it, but as long as we made one phone call
Yeah.
about anything, the light bulb, anything.
I mean, they've gone after passive owners of entities, of partnerships, like Sean alluded to. They've
Yeah.
gone after somebody sitting in California, they own a share of a partnership, they do nothing except get a check, right? And
Yeah,
they've gone after them for the $800 and
Yeah.
they lost on that one. But it's not an area you want to challenge because $800 a year over time adds up, plus the penalties,
yeah.
it's pretty steep.
Do you do any businesses? Because Tom Bordenaro was talking about assessment of airplanes and yachts and stuff like that. And it's like, how long was it in the state of California and when did it fly over?
I don't
Like,
have
you
any,
done
I don't have any
it?
clients with yachts or airplanes, so.
But if your yacht is done in a federal, like mine has a Coast Guard code versus the state of California code, you can get around that, just so you know.
Talk to Sean.
They play around that.
Yeah.
Can you share about the real estate professional status, what it is, how it works, and the benefits it offers?
So does anyone know what he's talking about?
Yep.
Okay,
Not passive.
This is a good question.
so rental property, which most of you are here to learn about owning property. Rental property by default is passive. It's a passive activity. So what that means is the government says if you own a passive activity, and it could be something else too, but it's 100% real estate. Rental real estate is passive by default, period. What that means is if you have a loss, you can't deduct it. At the base level, real estate's passive, you have a loss, don't get deducted. Well, so long time ago, government IRS came in and said, well, let's carve out a little exception for the little guy. You have a one rental, onesie twosies, whatever, you can deduct up to $25,000 a year loss being active in your rental, which if you own a rental and you're not active, I don't know what's going on. So for most people, you have the option of deduct up to $25,000 a year of rental losses. However, if you make more than $150,000, a number which has not been adjusted for inflation forever, if you make more than $150,000, you cannot deduct, you lose the $25,000.
What does
So-
that mean not make, like, after paying?
Gross.
Wages,
Coming in.
wages,
Income.
other investment income. If your other income is more than $150,000, the $25,000 carve out is per
Property
per
or?
person, per tax return,
It's a one and done.
per tax return.
So if you have like 5 rentals or whatever,
Right.
that's.
And they all lost, and you made less than $150,000, and they all lost $5,000, you would get to deduct $25,000.
And the 150 is your other income from a different, okay,
Yeah.
and that was actually a question I had, so. Say like you made extra money and you wanna put a down payment on a property. That's not, that would be on when you create an LLC for your rental property that you buy. So then, that's kind of what you're just talking about, sorry, I'm not explaining myself right. So you can't write off, because you're creating a business, so you can't write off the down payment, right?
No.
Of
So,
course, but then you could use depreciation instead.
right, so you buy a property, you work hard, you save up money, you put a down payment, you buy your first rental. You buy it January, just so it's a whole year. So, you land a tenant the first day, start collecting rent the first day, start incurring expenses the first day. I think these guys were saying you were projecting 4 years until break even on your kitty condo or whatever we call them. The first year you're gonna lose money. You're probably just gonna lose money because of depreciation, insurance, whatever. You're gonna lose money.
Just kidding, you won't.
Yeah, so if you make less than $150,000 in other income, wages, if you're married, spouse wages is combined.
Oh, other income.
Yeah, other income, yeah, like wages will throw it out for a lot.
You
of
guys are out of this one.
Yeah, so 150,000, you don't get the 25. So base level 0, little carve out for people making less than $150,000, $25,000, they can take up to 25 a year. Once you're at 150, bump kiss, you get nothing. So, but you lose that $5,000 a year. It doesn't go away. It builds up over time.
It rolls forward.
Rolls forward. So you keep the property 10 years. It's been magically $5,000 a year loss. I don't know how that would happen, but you've accumulated $50,000 of losses you haven't been able to use. It's just sitting there. So if you sell the property, that pent up loss gets released into your tax return. So let's say you sold the property at $100,000 gain, right? $100,000 gain. 50 of the losses you hadn't been able to use yet because of the passive rules get released and reduce that $100,000 gain down to 50. So they don't go away. They're there to be used in the future. So that's that piece of it. So base level, nothing. Carve out for people less than 150,000 other income is there. Once you're above that, you're kind of left with no options other than the real estate
Doesn't it
professional.
get better? Yeah, I was gonna say, it gets better.
Yeah.
This is
Yeah.
where this is gonna help you guys.
Yeah, but you need to be a real estate professional. You need to be in the real estate fields as your primary income. So real estate profession, agent, broker, that's your job. I've done it with an architect, a contractor. Pretty, the lone person would be a stretch, but.
I got caught, it doesn't work.
Oh, really? Oh, no.
And I was fine, I legally was fine, I got everything done and we made sure we didn't do it. They get audited every 5 years because I'm a bank. We're self-insured, so they do it to us. And we're gonna use it 1 year, and the gal goes, yeah, we're gonna get y'all all next year, so we were told specifically by the IRS to avoid it.
Yeah.
Crazy.
Oh, wow.
Do they know how many houses you sell? Jeez.
Well,
I use a real estate professional to sell my houses, because that's who you should use.
There you
I'm
go.
trying to track them for yourself.
so it's a pretty small universe of people that qualify for it. But if you do qualify, it's awesome. There's no limit. right? You can deduct the losses. With some, again, caveats, you still have to meet some participation standards, and you can group your properties or something. Well, I have 5 properties and I don't meet the qualifications on any one property. I can make an election to group them all into one, and now I meet the participation qualifications.
And it's like, what, 500 hours?
1,000
There's like 10
750
different,
hours?
there's quite a few different levels of participation. One is you do more than anybody else. I'm like, well, that's easy. But yeah, 500 hours
A year.
a year, yeah,
That's just-
per property,
10 hours a week,
Oh, per
you know,
per property.
2
That's why
hours a
people make
day.
an election to group them.
it's easy.
So you're trying to get these losses. You bought this property, trying to get these losses. You happen to be a realtor, awesome. You can deduct the losses. You don't have enough hours on one property, so you make an election to group several properties so you can meet the test. Well, if you want to sell one of those properties later, just one of them, you don't get to release those pent up losses for that one property because you haven't disposed of the group that you elected to combine. So you haven't disposed of the group. So that $50,000 you had saved up doesn't get to be released into your income when you sell that property.
Aren't you taking a loss each year though? If you're,
Oh, true. But let's say there were losses pent up before you went.
okay.
So in that example, because I've seen it
Like for the
happen.
4 that you were leading up to the 5th, that finally. gave
Right,
the
or you
loss.
became a real estate professional or something. Because if someone in this room became a real estate professional and they had losses, those would be trapped. You can't, by becoming a real estate professional, you can't just use the carryovers in that year. So in that scenario, you wouldn't release any of those old losses when you sold it. So that's one of the things our insurance companies like, make sure people know this.
Where does like fixing come in? Like you put a new roof, gutters, doors, whatever, like when something.
So that's another reason to consider a cost seg. So I had a client just replace a roof. They've had the property since 2013. All that was on the fixed asset schedule was land and building. Well, assuming they bought it in 2013, what would a roof cost in 2013? Let's say $10,000. So my software lets me split an asset into pieces. So I'd split the building into 2 pieces, and I created a new piece called roof, and it allocated all the prior depreciation to roof. And when we installed the new roof, I wrote off the old roof, but had to capitalize the new roof and start over again on the
Because the
27th.
price is more anyway, and so you separate it again. Like,
Yeah, but now it's separate, so if you do it again. So cost seg, the benefit is I wouldn't have had to make up a number, which, I did. But because you have a number in a schedule somewhere that you could point to. But yeah, that's somewhat new, I'd say, within the last 10 years. They allowed you to start kind of doing some of that, carving off a piece. John?
A simple tip though, also, because Tom will explain it. When everybody's looking at the Schedule Cs, a lot of people just put 365 days.
Sean scolded me on this one.
Yeah, well, because it cost me money. So when somebody's trying to qualify for a loan, if you put in there that you've only had the actual property valid, able to be rented 210 days, we'll take the 210 days divided by the income, and it'll expand your income.
Ooh.
If you have 365 days in there, they're just gonna divide it by 365. So the lender will give you less credit. So if you're in the middle of flipping a property or cleaning up something that took you 3 months, that wasn't actual days on the market that you could rent. So you go back to it and you get that modified. A lot of people are scrambling, especially that are self-employed, have loans, have properties, and we're always the last ones to file. And you'll just get lazy and you'll go 365 because that's what their computers download to. You want to go back and pre-check and go, okay, I really only had this for 5 months as an asset. So just do that for your future because everybody's using the DSCRs and all this other stuff. And who knows what's going to happen if the CFPB goes away as everybody's sitting at home. There can be a wild, wild west again. But that's some of those things you just want to have so you can go with a full doc instead of a state.
Just for long-term rentals?
For long-term rentals.
Not
So-
short-term or,
Why is that group not sharing?
Short-term is you're flipping them out too quick in that year.
Yep. Okay.
So this is what,
And one other,
so right here on your schedule, on your rental schedules, is your rental schedule. There's these boxes here. And,
Oh.
Sean's saying, fill that out correctly. Make sure, that if you pay someone, make sure
How
that
many days?
you let them know.
So if it's
Because their
vacant
system
for
will
6
default
months,
to a full year.
Right, so if you bought it mid-year and you put, you know, $10,000 of rental income and you didn't do this appropriately, and it may look like it was all year, they'd give you $10,000 of income. But if you put in the days to show there was only rented for 180 days, they would double it? Double it.
nice.
Well, it says personal days use, so like, what if it was a cabin and you're renting out the cabin for?
Did you really stay there or did you go up and do maintenance on it? That's what you need to think about. Were you up at the cabin vacationing for personal use, or were you up there having a work day on your rental?
Having a work day.
If you're at a vacation home, you're never enjoying it.
No vacation.
Calming, expense, not putting anything to it.
It's one other thing on that real estate professional, 500 hours seems really high. It is. However, if you're doing short-term rental, the threshold is 100 hours. So it's kind of a little loophole to get you into real estate professional status quicker is short-term rental loophole.
But you're still a real estate professional.
Or if you have a real estate license, I don't think.
You need your income needs to be predominantly.
Yeah.
Real estate. That's where you make your money. Yeah.
Different subject, when should a person, look at doing LLCs when they're buying rentals? Is it a number or?
I don't have one. What I tell clients is it's insurance. An LLC doesn't do anything for you for tax purposes, really. It's just insurance. So you have to decide insurance, liability insurance. You have to
just get an umbrella or.
Well, you have to do the math,
Right, calculate what your net worth is and then get an umbrella to equal that.
Or I do it from worst case scenario, what's the worst thing that could happen to this property? And then what could the judgment ultimately probably be? And how much would it cost to get an umbrella policy to cover that? If that's $3,000, then do the LLC. It's $800 a year. So it's cost benefit, but an LLC does nothing for you income wise.
And also don't group your LLCs, because as soon as you group it, they get to pierce the whole package. And
Yes.
that's why she's probably got 8 different ones, is because
Yeah.
if they sue on this trailer park, they don't sue on all 7.
Yeah.
It keeps it to where it's-
So you're saying.
they're asking for everything, but you got some.
An LLC for each property then?
I mean,
Yeah.
I do tax returns for a living, so for my own return, it's not an issue, but it doesn't take that much more time to do a little separate schedule in the return for an LLC. $800 a year.
I mean, but back to our conversation, since
Yes.
there's 5 properties, you want to have 5 LLCs?
It's up to you.
It's a
Yeah.
threshold, so it's like, what do you feel comfortable
Yeah.
getting sued at? Do you feel like comfortable,
Right,
like
yeah.
$1 million?
Yeah.
Do you
That's
have 5 properties that are 200,000,
And
So
or also,
I've done the umbrella route and I was rethinking, should I be going the LLC route? So, but you're saying if you have 5 properties, you're paying $800 a year for each LLC, or can you get one LLC cost you $800 for 5 properties?
you can do either.
Okay,
But
then one will turn you into a multiple cascading effect for everybody going after the whole nut. And
Yeah,
everything's
the whole
under one
portfolio.
LLC.
Yeah.
Okay,
I've
I
had
just want to make
people-
sure I got that.
I've had people tell me to put like no more, like this was several years ago, like $3 million worth of property into one LLC. I don't know what that was. And then also on LLCs, if you make over $250,000,
good point.
you're not paying 800, you're paying another 25,000 or what
No,
is
it's
it, 2,500?
another 900.
900,
Yeah.
yeah. So
So that's
it goes
true.
up as you make more money, each LLC.
each LLC.
Right.
Sounds like LL lose.
But there's a pass-through entity, that $2,500 pass-through entity that does something.
It'll get up there. I mean, the LLC fee gets up there.
And tax filings, what do you,
Huh?
I don't know if you want to share that, but like,
What?
what do you charge for a tax filing for an LLC?
Single member LLC. So.
Why not? Yeah.
So if you just own an LLC, right, just one LLC, single owner, husband, and wife is considered single, can be considered single. That's just a California only form that kind of gets done at the end of the process. So it's probably another $150.
It's a pass through anyways.
Yeah,
Can those go also in your personal return?
that is in your personal return.
Yeah. What if it's a multi?
That's a partnership return, and I would,
See your turn.
yeah.
Oh, goodness.
Yeah.
So
What?
And I said, what if you're 4 partners in 4 different states and you need K1 for each one?
Yeah, that's a partnership return, and it's, yeah. And it depends at that point, it depends on the books and records, because you know, bookkeeping. I used to roll it onto one, somebody'd bring me their crap and I'd give them one price for the tax return, like, here you go. Have to sort through all their stuff. Now, several years ago, I said, that's dumb. So you bring in a pile of crap, I'm gonna charge you to go through all the pile of crap and get numbers I can use. Then I'm gonna charge you for a tax return after that. And I don't start on the tax return until I've worked my way through your stuff to get to numbers I can use to do a tax return. So they're two separate services. I used to give it all the way in one price. I'm like, I was dumb. Especially in tax season when time is very, very, very valuable. Yep, Sean?
And you usually send the template out anyway, so you can sit down with your own template.
Yeah.
And sort of figure out where your numbers are long before you go see your town.
If you have a business, you should have QuickBooks. Rental properties, not really. Don't need them for rental properties, but you should have a system. And the system can be paper, it can be spreadsheet, it can be whatever, but you need a system. Partnership needs QuickBooks, period. I mean, you got partners, you got money going around, you need QuickBooks, yeah.
What's your threshold on repairs versus capital improvements?
Yeah,
Repairs, so.
yeah,
I use a lot of repairs.
yeah.
25.
Sort of ratio to income. You know, if somebody has a commercial property bringing in $500,000 a year and they got 70,000 repairs,
Pretty logical.
they have $20,000 of rental income and 70,000 repairs. Let's look at this a little bit. Let's see if we need to capitalize some of this. And because I don't have a lot of patience for digging down into stuff either. People don't want to pay me to dig down into stuff. But and historically, I mean, I have a client with, I don't know, a lot of rental properties. Nobody in this room. And I should ask him if I can give him your number and he can come talk because he's remarkable.
Bring him in, come on.
But among all of these properties,
New speakers.
in 1 year, it might be $300,000 in repairs. But there's 20 some properties and I don't know, $1 million of rent, maybe. More than that, way more than that.
Yeah.
But it's just kind of like, you know, and there's some on this property and some on this property and some on this property. As long as you're not lying to me and the numbers are good, I don't get worried about it. But if the ratio is out of line, I want details, then we'll capitalize some of it, write off some of it.
What do you charge for multi-member LLCs?
Partnership?
Is that a partnership?
Yeah. Yep. Probably 1,800 minimum with good books.
It's a very important caveat.
With good books. Without good books, I probably wouldn't even do it. Yeah.
Can you share what you shared last time, which I forget the name of it, but basically if you have the intent to buy a property, but end up later demolishing it, you can.
Right. So at the base level, if you buy a piece of property, dirt and a building, and you intend to demolish it, you don't get to write off the value assigned to what you demolished because you were going to demolish it. It has no value. But you can make this election, and I did this on my own return. We bought a property in Rio Grande. We're going to demolish the building and build an office building, mixed-use building, and made an election where I got to capitalize and depreciate the structure we tore down. So don't just take it at a lot. Don't just assume it's going to be a zero. There is something you can do to depreciate that over time.
How were you able to buy that and say that you didn't have the intent to demolish it when you had the intent to build a building? Because that's kind of what I'm going for.
It's several years ago. I don't remember. It's the only time I've ever done it was on my own return. Because it's the only time it's come up. I'd have to go back and look.
So I guess if you were going to buy a piece of property, there's a building on it and it has plans to build more units or something like that. You're going to buy it with the intent, hey, I'm going to rent this, but then you're going to demolish it. Does that kind of work?
I have to go back and look.
I did go back to the county, come to the city and try to figure out if that old white building was usable, and then it's no, because it would never make.
And they wouldn't rezone it.
So it just turned into a pile.
It was residential, they converted it to commercial, and then they wouldn't convert it back to residential. Because, I mean, it takes you a year to get anything done. It's just like, let's rent it while we can. I mean.
Okay.
Yeah. But if you want me to, I'll have to go back and look at.
Yeah, we just found it super interesting because it's kind of a hack that I've never heard of.
Yeah. I was desperate, found it.
You play the years, not the calendar, not the 30 not a 12 month, but you play the calendars. If you did it in 2024, and you sell it out in
Yeah.
25,
Tax returns,
that helps
tax returns.
a lot. Sometimes
Yeah.
also when you play with your numbers.
Yeah, so, you want something to appear in as many tax returns as possible. So you buy it December of 2022, put it in service in 2022, and then sell it January 2024. In reality, it was 1 year, but it shows up in 3 tax returns. So,
And a lot of people will hesitate to even put it in there because they're figuring they didn't get any rent, there's nothing
Yeah.
really happening.
Yeah.
We suggest you put it in there so that you can book that year as it goes.
and nobody knows what returns get selected for audit. I mean, of course, there's probably obvious ones where you have huge meals, entertainment or something. But just average tax returns, no one really knows what triggers them, what triggers an audit. I have guesses. I've probably had 2 audits in 22 years. And I think one was the ratio of cost of goods sold. Somebody was service and product, usually heavy service, small product. 1 year was heavy cost of goods sold product purchases, smaller service, boom, audit. And so I think it was the ratio, the cost, the gross margin, I think is what triggered it. I don't know, but I think that's what triggered it.
Talking about audits, did you notice any more audits? Obviously, probably not, but like when they were hiring a bunch of agents and now they're letting go a bunch of agents?
No, I mean, our job really,
Seen any effect?
your CPA's job really is risk management. I mean, that's really how I look at it. And this might sound weird, but no return I do is perfect. You don't pay me for perfection because, the diminishing returns, you get you 90, 96, 97% correct up here to get you to 100, the cost benefit is just way gone. I could look at any return done by anybody and find mistakes, but it's not gonna be a big one. Well, in most cases, it's not gonna be a big one. Do you want to pay me to go through your checkbook and look for every possible thing I can find? No, you don't want to do that. Yeah.
My question has to do about gifting money to a family member.
Am I family?
Oh, good. Look in the book.
Actually, real quick, in my hometown of Ukiah, there was a CPA, his last name was Crook.
Wow, that's funny.
Sorry, go ahead.
So I think you can gift a family member, or 18 grand,
I think it's 19 now.
19 now. All right, so if I have a son who I want to help launch into purchasing a home and I don't
Talk to your lender.
have him wait till I die to get the money. So, and he has 2 children and a wife. So I can give each one of them 19 grand.
Are you married?
Yes.
You can double that.
No.
Then my wife can give the same amount.
Yeah.
I do it in December, so now it's 19, we're talking 80, so almost 160 grand in December of the year. I hit January and I can do it again for another
Wait,
100.
what? Where that math might be again?
Okay, 19, let's just round up to 20.
That's 80.
There's 4. There's 2 children,
Oh, okay,
2
got it,
grandkids,
got it.
a
Okay,
wife
got
and
it.
a husband,
Okay.
so that's 80.
Right.
Then my wife comes around, gives them 80, so that's 160. I wait till I do that in December, then I hit it in January, I do it again, so I can put about 320 in their pocket of gifted money. That
Are you
they can buy a
adopting?
house.
Yeah, so I'm not an attorney. You might have a problem with the gift to the minor. I would, not sure about that one. Not sure how that works, where the parents can just take that money and use it for what they want.
Gotcha.
Not sure. But yeah, that's how it works. But if you did that January 1st and they go to get a loan January 2nd, because they're chomping at the bit to buy that property, they're just waiting for that extra 160. And that money just hit their bank account.
All right, you need it 30 days or whatever. Or
Seasoning.
60.
How long?
You don't need any season.
Oh,
You
really?
do it all in the same day.
Really?
There you go.
We just
Yeah,
have to track the account it came from, to where it's there.
And do you need a gift letter, which,
Gift letter, and our gift letters are not IRS approved, and they're not given to the IRS.
Right. right?
And right now, the government's not talking to each other branch, so it's actually a pretty good thing going on.
I got another question to add on to that. If I wanted to take the same approach, if I bought a house with my son and it's a rehab and we rehab it, we're tenants in common on title. Then after we buy it for 5 and redo it, we get valued at 8. we in theory could take whatever, 400 grand out, and he could go on his merry way to buy something. And then take out, and then have the rental pay down the outstanding balance.
Yeah, you got a couple of games, you got a lot of those things.
Sure, you're selling it or not selling it?
Not selling, keep it.
You're keeping it.
You're saying on a cash out refi? You're like refining that
So you
400?
pay cash for the buy, remodel it
With cash.
with cash, so you got the place at 800. He's on title. We take a loan out, give him the 400 grand to go buy a place, and then just get a.
So he's also on the loan.
Pardon me?
He's also on the loan.
Correct.
And is he gonna pay cash for 400,000 or is he getting a loan?
Whatever you can get for 400 grand.
Okay, but no loan on the other side for him.
Yeah, because that'll count towards his debt now.
Yeah.
Okay.
But you'll have rental income, right? So.
No
Okay.
income.
No rent.
The other thing that you're gonna end up with when you're doing that, and you're taking it from this to move it over there, you're gonna now transfer all that and track that. And if, a lot of people try and do it with a primary residence, and then it's not valid at that point, because Tom's already told us that we can't
The money has to
move
stay
it.
there.
And it doesn't move over because it came from a primary. The other thing you have to be careful at, that a lot of people are doing on the private tax, your taxes you pay for your county, is people start switching all the percentages on something. And then they switch players, they add a kid to their, and a lot of people, when they get married, they start throwing all these spouses on stuff.
50%.
And so the benefit is, yeah, they're on it, but you gotta be careful how you held that entity. Because if you were a partnership and now you've changed it, added somebody, you've just reassessed that percentage you added that person in, even if it's a spouse. So there's a lot of things that you gotta talk about before you get married, of saying, you're better off just having the trust say, I'll protect you that way, than start putting names on all the stuff. So we've had an apartment owner, they got.
Yeah,
burned for that.
LLC returns, partnership returns, I think S corp returns, maybe not. California, all have questions on them about transfer of ownership. Did you transfer any ownership of this property during the year? So you're signing that return under penalties of perjury. People try not to do it. And not report it, but yeah. Cash is better. I mean, you're only, speaking as a divorced guy, you're giving an irrevocable gift to your daughter. That is then hers as well. So,
Right. Okay, I didn't look at my options.
yeah.
I'll get you a loan, don't worry.
Awesome.
Also, if you haven't signed in yet and you want to be on the invite list for all the future investor meetups, there's pads circulating right here. So make sure to put your name, phone number, email. That way you get the email and text blasts about the next meetups.
And then add the Facebook group, SLO Real Estate Investor Group Meetup.
Yeah. And on the Facebook page, we're always swapping deals. Like there's off market deals that are on there. People are looking for buyers all the time. So if you want to get some good deals, if you're a cash buyer, we're building a list of, properties on there that never hit the market. So we'd like to work together with this group to make that happen.
Hey, Tom, one more question, in line with what he was talking about. Isn't there can't parents give their kids early inheritance up to like $12 million or something like that? And there's no tax repercussions of that?
Yes, so, the way that works is if you give less than the 18, 19, whatever, 20, we'll just round to 20. If you give less than the 20, you don't have to tell anybody anything. You don't tell the government anything. If you give more than 20, you're filing what's called a gift tax return. Gift tax return, you list your gift, you compute the tax on your gift. You give 100,000, you compute the tax on your $100,000 gift. There's a number of tax. The $22 million, $12 million, $24 million, really equates to, that's a value number, but it really equates to a credit, a tax credit. So the way the return works is you give a $100,000 taxable gift, compute the tax, then you use some of your unified credit to reduce or eliminate the tax, but you've used up that bit of your credit going forward. little bit more than you need to know. But yes, you could give right now, if you wanted to, anybody $12 million and pay no gift tax. But then you couldn't give any more. At death, done.
My last name's got 2 U's in it in case you want to give that to me.
Yeah. Yeah, so it's use it now or use it later. And you're gonna see a lot of people so using round numbers, let's say it's at 12 million right now. And it's scheduled to go back down to 3 million in 2026, which I'm using round numbers, but it's in there somewhere. If they don't extend it, it's going back down. You're gonna see a lot of gifting. A lot of gifting. Wealthy people using up their $12 million, knowing it's gonna go down to 3 million. It'll be December 31st. But there's gonna be a lot of gifting late this year. People with large estates trying to use their full $12 million fair market value to pass on the wealth before it goes back down to 3. So.
There's a lot of giving people in here tonight, and we want to thank you for giving your time. So.
Thank you all for being here. So please sign in if you haven't had a chance to yet. And we'll be doing this at least once per quarter. We really want to make sure this is valuable. And so we're looking for great guest speakers that can really share new concepts. So if you know any other real estate investors, some good people who would be a good guest speaker to have here, or if you have ideas, like you want a panel or what kind of topics you want to cover, let us know, because we're always looking to make this group just help the people who come. So
Did you do the ADU one over at the Quality Inn?
we did.
That
Yes.
was awesome.
Yeah. ADUs are great, and they just changed some new laws where if you have like a multifamily property, like let's say you own a fourplex, you're actually allowed to add up to 4 detached ADUs on that property, up to 8 units for multifamily. So it's huge. So really big change, and I want to have someone come back and share on that. So that would be a good topic.
I think this is a CPA article.
Okay.
All right, any other comments, questions before we head out? Needs, wants, anyone have a deal off market, flip something, let us know. All right, thanks to Mingle, and then we'll see you guys next time.
Log that taxes. Yeah, thanks for having us this
You started your.
Yeah, very appreciate that.
Yeah.
Make sure you
Yes, state tax. Yeah, because it's really one credit, they give you credit. It's not a $22 million credit.
Scar, I can steal like.
No, but it's 5 city CPAs. Yeah, but,
Tax credit limit, or whatever it's called.
it's called a unified credit. That's what it's called. That is really, that's the real number. It's easier to go out fair market value assets. Yes. It's, you know, here's the secret. The main thing is math. Hopefully you learn something, and that's the key. Yeah.
We saw that in the bay, we got that.
Is that last year?
Yeah.
That was just, that was just like